Thanks for joining our webinar this morning. My name is Roger Cadlack. I am serving as president of the Minnesota Mortgage Association this year, and we are thrilled to have Michael Fratantoni on our call this morning from the MBA. A couple of quick housekeeping items. During the presentation, if you have questions, Michael has invited you to just type them into the chat box or the questions box, and he will address them as he goes through the presentation. You'll have 40 to 45 minutes worth of content, and then at the end, we'll have it open for questions as well. So, Michael, thank you so much for joining us. Michael is the Chief Economist, Senior Vice President of Research and Industry Technology. In his role, he's responsible for overseeing MBA's industry surveys, benchmarking studies, economic and mortgage origination forecasts, industry technology efforts, and policy development research for both single-family and commercial and multifamily markets. Prior to joining the MBA, Michael worked in risk management and senior economist roles at both Washington Mutual and Fannie Mae. He's received his PhD in economics from Johns Hopkins University and a BA in economics from the College of William and Mary, and has served as an adjunct professor at the University of Washington, Johns Hopkins, George Washington, and Georgetown University. So, Michael, we are thrilled to have you on the call today. I'm going to turn it over to you and mute myself and let you have at it. Thank you, sir.
Great. Thank you so much for having me here today. We were just talking a bit about relative weather in DC versus Minnesota. I've had the pleasure of being in Minnesota at this time of year. I also had the opportunity to speak in Minneapolis in December once when I believe it was -20 when I got out of the cab. So appreciate the opportunity to be here with you virtually, and looking forward to when we can get back together in person again. In terms of my talk for today, what I've found useful really as an organizing concept recently is to really try to identify the handful of questions that folks in the industry are really curious about. And these are questions where there aren't clear answers. We've got forecasts and we've got insights and we've got expectations, but I think each of these questions are really open for debate, and my views on these, MBA's views on these, may differ from other forecasters or other analysts that you might speak with. But I think from a business standpoint, that's actually pretty helpful, because I think when you're considering different scenarios under which your business might be operating in the year ahead and beyond, I think it really is critical that you look at a range of different possible outcomes, because obviously for mortgage, it's incredibly important. And so the one that you always got to start with is where do we think rates are headed? And obviously a number of different factors influencing that. And let me start with the factors that I think are going to keep rates relatively low. Most importantly, really the state of the job market. So have a chart here showing initial claims for unemployment insurance. For much of the time that I've been watching the past 25 years, this is a number that's between 200,000 and 300,000 on a given week. You see back in 2009, we had a record above 600,000. And I just love showing this chart because it just indicates just how different this crisis has been from anything we've experienced before. Because where the prior peak was 600,000, this peak was at almost 7 million, right? So the speed and the scope of this downturn is just completely unprecedented. Now, the other aspect of this chart, which I think gets people thinking, is all this conversation of, is this going to be a V-shaped recovery? Is it going to be U-shaped? Is it going to be W-shaped, where we have a second stage of the virus that hits the economy and you get a double dip in terms of the job market. You know, this picture, you can make arguments along any of those lines, right? So initially, it sure was V-shaped. We had the initial downturn in March and April. April was the absolute low point. In May and June, we saw pretty rapid recovery in terms of a number of people that had been temporarily laid off being called back to their jobs. But by the time we got to July, it has noticeably slowed in terms of the pace of recovery. And I mentioned that, you know, this morning's news, we're back up over 1 million in terms of initial claims for unemployment insurance. So the first, you know, 8-9 million employees returning to work, that proceeded very smoothly and very quickly. But our expectation is that from here on out, it's going to be a bit of a tougher row to hoe. So if you think more in terms of the unemployment rate, back in February, we were at a 50-year low of about 3.5%. In April, we jumped to 14.7%, which is the highest since the Great Depression. We were at 10.2 as of July. We think we'll probably drop to about 8% by the end of this year and 6% by the end of next. So improving, but not back to the 3.5% we were previously. Now, definitely want to talk to some of the data reflecting more Minnesota than the United States, but as you'll see in several of the charts I have here this morning, I mean, I think it's interesting just how closely the path for Minnesota has tracked with that we're seeing nationally. So the orange line here is the unemployment rate for Minnesota. So where the U.S. Low point was at 3.5, Minnesota doing even better at 3.1. The spike not quite as tall as that for the national unemployment rate, and the recovery not quite as rapid. So as of June, unemployment rate in Minnesota down to 8.6. But just given how highly correlated these two have been thus far, I guess my expectation is, you know, if you're tracking the national numbers, it sure seems that at least to this point, Minnesota's on a very similar path. Similar story if instead of the unemployment rate, you look at the level of non-farm payroll employment. And, you know, this picture really just highlights, you know, again, just how extreme this episode has been of tens of millions of jobs lost in that March and April timeframe. And even though we're still talking about, you know, 1.8 million jobs gained in July, look at that blue line, look at how the slope of that rebound really has slowed a bit as we've gotten into July, and anticipate you're going to see a similar slower level of improvement in August as we saw in July. And again, the numbers for Minnesota tracking fairly similarly. So from a level of almost 3 million jobs, now at about 2.7 million, so still about 300,000 net down over this time period. So the big picture here, again, the connection to rates is with a slower improvement of the unemployment rate from here, and that's just reflecting overall state of the U.S. economy and in Minnesota as well, that is going to keep downward pressure on rates. Not that they can't rise, but this is definitely going to be a factor keeping downward pressure. Another one, and I think this is a really important picture to keep your eyes on, is we're a little bit here on our precipice in terms of what the next stage in this episode is. So if, as I sketched out in the prior slides, it's just a matter of slowly improving economy, maybe not rebounding as quickly as we would want, but heading in the right direction, that's a pretty positive outcome in the scheme of things. But this picture is pointing to, it's a little darker. So this is looking at the number of commercial bankruptcy filings This is through May. We just got the June numbers this week, staying at this high level. So certainly running above the pace of bankruptcies recently. And why this is so important, again, I mentioned so many of these millions of individuals who were laid off have been reporting that they were temporarily furloughed. So they anticipated going back to their prior job once the economy rebooted again. But if the company shut down in the interim, there's not that old job to go back to, and then the cost, expense, and time of searching for a new job gets added into the mix. So if we really see this number of commercial bankruptcies run much higher, that is going to further impede the ability of the job market to rebound, and hence households to continue being able to provide for their families if they can't get back into those jobs. And flip side, really emphasizes the need for government policy to continue to be supportive of this economy. So showing this picture, this is from the Congressional Budget Office and Treasury, looking at outlook and current measurements on the federal budget deficit. So going into this year, the expectation was that the federal budget deficit would run about $1 trillion in fiscal 2020 and about the same in fiscal 21. But as stark and severe as the economic downturn has been, the policy response has just been phenomenal as well. So the CARES Act that Congress passed and the president signed this spring injected almost $3 trillion into the economy in the form of direct support for households with stimulus checks, enhanced unemployment insurance benefits, support for various industries, the Treasury providing support for a broad swath of liquidity facilities that the Federal Reserve could use, and various other dollars that not only did they pass this, but they constructed it in such a way that the money got into the economy very quickly. And that was, again, a huge surprise. We looked at the data for April for the economy. Personal income for households in the US actually increased. And that was a result of a 90% month over month increase in transfer payments, so those stimulus payments and unemployment insurance benefits. So remarkably helpful. And this is one where the concept or the illustration that people used was the government wanted to build a bridge over this pandemic, knowing that the private sector had to shut down in many cases to keep people healthy. And was that bridge going to be sufficient to get us from one side to the other? And there's still uncertainties out there, but it was quite an effort, to the point now that I think where MBA is, where many economists are, we don't think the private economy is quite ready to stand up on its feet yet. We think the Congress really does need to pass an extension in some form, particularly of the enhanced unemployment insurance benefits for the millions of folks that are still out of work and looking for jobs. And I think another round of stimulus payments would certainly be helpful. Again, we're at a 10.2% unemployment rate, which is above the peak that we saw in 2009. I think, extend this bridge out another couple of months through those kind of efforts would be very helpful. But then back to this picture. Instead of a $1 trillion deficit for this fiscal year, CBO is now predicting about a $3.5 trillion deficit. And instead of $1 trillion next year, something on the order of $2.5 trillion. The debt to GDP ratio for the US is now rapidly approaching the peak we saw during World War II. This is a lot of debt that Treasury is going to issue. We think this year alone, it's going to be a number like $4.5 trillion of Treasury bills, notes, and bonds that are going to be sold. They need to find buyers. The Fed is buying some Treasuries, but this is definitely the most important factor that could be pushing upward on rates. Don't expect any spike in rates, but I expect that if the economy advances as we're anticipating, we think that this factor of larger deficits leading to additional treasury issuance is going to ultimately result in somewhat higher rates. So let's look at our forecast and answer that first question of where do we think rates are headed. Well, first, the Fed, again, also been extremely active through this crisis and have committed. They just put out their minutes this week from their July meeting. They're going to keep their short-term rate target at 0 at least through 2022. So that's what we're showing here. Now, longer-term rates are going to respond to the recovering economy. And if you look at the green line, the 10-year Treasury rate, that's also going to respond to the rising budget deficits that I talked about and just the incredible amount of debt issuance that's going to have to happen to finance those deficits. So we see 10-year Treasury rates rising from 65 basis points where they are today to about 130 basis points by the end of 2021. Just to put that in perspective, in February of this year, we were at about 140 for a 10-year Treasury rate, which was a record low. So our forecast of getting back to 130 would still be this environment of very low mortgage rates, just not quite as low as we are today. If you look at the red line, mortgage rates generally are going to track with Treasury rates, but we think they're going to rise more slowly than Treasuries because you don't have the same supply-demand imbalance in the MBS market that you do have in the Treasury market. All right, so that's our expectation for rates. We think mortgage rates are going to slowly rise from the record lows we're at today to still very low levels over the next couple of years. So with that forecast, how long are we going to continue with this refi wave? These are a couple of nice charts that Black Knight puts out as part of their mortgage monitor, looking at, particularly on the right, the number of households that would have at least 50 basis points of incentive to refinance at different levels of rates. So I haven't seen the Freddie Mac number yet this morning, but it's been right below 3%, close to record lows. In our weekly application survey, mortgage rate at about 3.1%. So we're at the very left end of this distribution, showing 16 to 18 million households at today's level of rates have a substantial incentive to refinance. And even if rates were to go up 10, 20 basis points, which is what we're thinking is likely to happen over the next year or so, you still have 11, 13 million households with 50 basis points of refi incentive. So there are plenty of households still out there who are going to be interested in talking to you about refinance. So what have we seen in terms of level of activity thus far? So this is data from our weekly application survey. The blue is the 30-year fixed rate, and you can see that we have just gone ever lower. So remember, there was a time when you thought, would we ever go below 4% in rate again? Not only did we do that, but in terms of the Freddie Mac series, as I said, we're now below 3% from some lenders. So initially, when the crisis hit in March, you had a big downdraft in rates, and you see that spike in refi application activity well above 6,000 on our index, which is the highest it had been since 2009. Since then, we've just seen more of a sort of rolling boil in terms of pace of refi application activity, around 4,000 or so. So for much of this year, we've been running 50, 60, 70% ahead of the pace of refi applications this time last year. Last summer, due to a slowdown in the global economy, we saw rates drop a bit and refis pick up then. But our expectation, and you even saw this, the news over the past week, Fannie Mae and Freddie Mac announcing an adverse market fee on refis, which is going to push up rates on refis by about 1/8 of a percentage point. And you don't have to move rates very far for a couple of million borrowers to no longer find it advantageous to refinance. So in the weekly data, we saw a 5% drop in refis last week, and again, it was just announced on Wednesday night. So our expectation is that's going to cool the pace somewhat, but we are still anticipating fairly robust refi volume through the end of this year, and then tailing off to a greater extent as we get into next year. And want to give you some local color. The orange line here looking at year-over-year change in refi apps for Minnesota, and then the blue is the US, and very, very similar patterns. You see that spike in March, and yet still thus far, running 50% ahead of where we were last year at this time, both for Minnesota and the US. Now, most of the strength in this refi market is really in the core of the conventional sector. So, loan sizes 300,000 to 400,000. We're seeing a little bit less robust on both ends in the government sector with a lot of first-time home buyers, entry-level homes, and in jumbo. Jumbo, you're seeing both tighter credit, and then here I'm showing the spread between 30-year jumbo rates and 30-year conforming rates has picked up quite a bit as almost all of these loans are being put on bank balance sheets right now, and there are a lot of competing demands for space on those balance sheets, and as a result, banks have priced up jumbos relative to where we were pre-crisis. So I think folks in the industry know this, but it's sometimes a surprise that if you look from the period from 2013 through February of this year, jumbo rates were running below conforming rates, where for most of my time in the industry, certainly my 9 years when I was at Fannie, you could count on conforming rates being about 25 basis points below jumbo, but that certainly has changed over the years, primarily as a result of sustained increases in guarantee fees coming from the GSEs, but also some very strong demand from banks for jumbo loans. But again, in terms of that refi demand, core the conventional market was where it has been thus far. I do think if you have a number of clients who have jumbo loans, I think refi demand in the jumbo portion of the market could be a little bit of a tail to this refinance wave. So it could remain stronger as we get into 2021. All right, moving to my third question, which is certainly more relevant to the purchase market. But what do we think is going to happen to home sales and home prices? So first, let me start with one of the hurdles that we're thinking about. These are data from our Mortgage Credit Availability Index. So what we do is look at the criteria that investors and mortgage insurers and GSEs and aggregators have out there in terms of the types of loans they're willing to take credit risk on, and look at items like what's the maximum loan to value, the minimum credit score, max DTI, do they take investor and second home, et cetera, and then look at the relative risk of those factors and then combine it all into the single metric. We track that over time. Obviously over the past decade, before this crisis, we were seeing some increasing credit availability across the board. But March of this year through June, we saw sustained tightening across those 4 months. Getting back to what I was saying before, that was happening to the greatest extent on sort of either end of the market. A lot of overlays being put on government loans. So whereas many lenders had minimum credit scores of maybe 620 back earlier this year, it wasn't unusual to see a minimum of 680 by the time we got to May and June. Perhaps a little bit of loosening as we got into July, so kind of a leveling off. Then I mentioned the challenges on the jumbo side. We've actually seen our index here drop 60%. From February through today. So this availability of credit, always critical for home buying. And I guess my expectation would be if the economy recovers, as I was indicating in the discussion around rates and the job market, and then would expect credit to loosen through the course of next year. If that were not to occur, then I think we really, at some point, this would be a severe hurdle for the purchase market. Now, when I talk about the purchase market, I'm often describing it as really the biggest positive surprise in this crisis. And I was talking to a reporter yesterday and saying that, for example, if you looked at the housing starts data this week, really points to housing being the bright spot in the US economy right now. And I think our data really was providing an early indication of that. So what are we showing here? This is data from our weekly application survey focusing just at purchase applications. And each line is a successive year on an unadjusted basis in terms of that purchase application volume. So if you focus in on the black line, which is 2020, and the red line, which is 2019, I just want to highlight a couple of things. So going into this year, given the very favorable demographics, the millennial cohort reaching peak first-time homebuyer age, low rates at that time, and at that time a very strong job market, we were anticipating about 5% growth in purchase volume 2020 compared to 2019. And that really was bearing out in the first couple of months of this year. Then the crisis hit. You see the black line dip well below the red. We were 35% below 2019 in the worst of the crisis. But then in May, almost as soon as some states began reopening, we saw this very rapid rebound. And really from mid-June on, we've been running ahead of 2019 again, with in recent weeks more than 20% ahead of 2019 purchase volume. So yes, you might be concerned about credit being tight, but at least to date, it is not showing up in any slowdown in purchase application volume. Now, a question could be, okay, is this just pent-up demand? Are these buyers that would have more naturally bought a home in March or April or May, and instead they're buying in June, July, or August just because they can? I think there's certainly something to that, but it has not slowed down yet. And you talk to realtors, talk to other folks in the market, it just seems like incredibly strong demand. And the data from the builders out this week, that they are just seeing unbelievable levels of traffic in terms of their new homes for sale, and their expectations for sale 6 months out continue to grow. So people are out there buying homes. Again, you look in your state, seeing this very similar rebound. So April was the absolute bottom in terms of purchase application activity, and May sort of flat to last year, June running ahead of where we were in 2019. So what does that mean for home prices? Well, the purchase application data I was showing you, really that's a sign of demand, right? You have a lot of households that have the desire, have the ability to buy a home. There's the concern about credit availability. Are they going to be able to get the financing, even though they've applied? Then the next question is, are they going to be able to find a house to buy? We have seen listings of existing homes still running below last year's pace. And although the data for July in terms of housing starts was positive, we're up about 23% on the month, and very strong level of starts and permits. So we are getting some additional units on the market. Overall, inventory is still extremely tight. We're talking about 4 months of supply, where 6 months is closer to typical. So that gets us to this picture, which is, again, one of the surprises for some folks who had, having lived through the great financial crisis, expected, well, you have a recession, that means home prices are going to go down. And at least thus far, our call was that that's not the way it's going to happen. That in the great financial crisis, we went into that episode with too many homes having been built and inventories really, really, really large. And that just sets you up for a drop in home prices when credit was pulled back. This episode is just so different in so many ways. Inventory was tight the last couple of years, and then with the crisis, builders essentially stopped for a couple of months, and existing owners pulled their properties off the market. So we are still seeing home price measures come in with numbers like 5% year-over-year growth nationally. Now, again, this is a national number. There are going to be differences. If I'm worried about home price declines, it's going to be in some of the big cities, New York, Manhattan in particular, or San Francisco, where some of the sort of hypotheses about people leaving big cities to go to the suburbs, it actually may impact some of those very local markets. But I think when you pull the camera out and look, state level or certainly regional or national, we're just not seeing it. And it's the combination of having this very strong demand rebounding out of the crisis and the very significant constraints on supply. So our expectation is that builders are eventually going to catch up to this demand. So we think over the next 18 months or so, you might see some deceleration in home price growth. So instead of 4 to 5% growth, you'll see 3.5% growth. But again, if the broader economy recovers as we're anticipating and rates stay in the neighborhood of sort of 3 to 3.5%, we don't see home prices going down. Now, there's two sides to that coin, right? So for potential home buyers, it becomes an affordability challenge in some markets if home prices continue to grow faster than income is growing. So that's going to be a little bit of a break on the origination side. But if you're looking at this from a servicing side or sort of a housing market confidence side, I think growing home prices are a very good measure, a very good feature in that it's going to prevent some of these delinquencies that I'll show you in a minute from going all the way to foreclosure. Because if you have borrowers in distress and they're no longer able to stay in their home, at least in many markets in the country, they're going to be able to sell that property, and we're not going to see the challenges of underwater homeowners that we saw in the great financial crisis. So one more picture here of Minnesota very closely tracking what we're seeing nationally in terms of pace of home price growth. Almost uncanny how closely it's tracking. So you guys are very representative of the national picture in terms of the tight inventories we're seeing and how that's leading to more rapid home price growth than certainly you would anticipate given level of inflation and level of wage growth. All right, next question. This has been a good year for mortgage lenders thus far. I have seen volume stay very high, and I've also seen very significant margins on the origination business. So how long is that going to stick around? So let me just start with our origination forecast, and going back more than 20 years now. So this is our July forecast. We'll be out with our August forecast possibly as soon as today, maybe tomorrow. This is the challenge of doing presentations. We're always on the edge of some new data or release coming out. But if you look at 2020, in July, we had been anticipating 2.8 trillion in volume. The August forecast, I'll give you a sneak peek, is going to be closer to 3 trillion. So the refi volume at 1.5 trillion, we think is going to be over 1.6. So we are just very much tied to the application data that we're seeing, and then we translate that into our expectations for volume. So 2020 going to be the highest origination year at least since 2005. and there's a chance we could beat that, with 2003 still standing as the all-time record. Do anticipate, with even a slight increase in mortgage rates as we're forecasting, that this refi wave is going to ease off a bit in the fourth quarter of this year, and then decline from sort of rolling boil to, something more than a simmer in 2021. And that's reflected here as refi volume dropping from 1.6 trillion in 2020 to about 700 billion in 2021. The red line here, do expect purchase volume to continue to grow, given our expectations of an improving job market, still growing home prices, and again, these very favorable demographics. But all in to the question about margins, we're going to be likely seeing a pretty sharp decline in volume. And every time that's happened in the industry's history, that often is coupled with lenders wanting to get one more squeeze of juice out of the market, and accepting tighter margins as volume is dropping. So I expect that certainly by the end of 2021, going to be feeling kind of reminiscent of what we had in 2018, of a much tougher market than what we're seeing today. So I think from sort of a business planning standpoint, certainly enjoy the volume and the margins we're seeing in 2020, but I would not anticipate those are going to stick around all the way through 21. And just as a visual for margins, sort of a quick look is looking at the spread between 30-year mortgage rates in red and the 10-year treasury, and the yellow is showing that spread. That spread has typically been about 180, 190 basis points. We were as high as 260 back in March and April, just as a result of the financial market disruption impacting market for MBS. And primary secondary spreads really wide, just given capacity constraints across the industry. It has started to come in through July and into August. I think last week's news from the GSEs throws a curveball into this. Not quite sure to what extent that's going to keep things wider, just given the costs that some lenders are getting hit with here on their locked pipelines. But do expect that, again, if volume really were to begin to drop noticeably into next year, that this is where you would see it first in terms of margin tightening, would be this spread coming in. Now, the margins we're talking about on the origination side, this is data from our quarterly mortgage bankers performance report. This is looking at net production income in basis points of origination volume. On average, over the past decade or so, that's been about 60 basis points. You can see those tougher times I was talking to in 2018, where at least in first and fourth quarter, when purchase volume is light, we actually saw losses on originations once you fully load all expenses into the calculation. Definitely saw an improvement in 19 once the refi began to kick in. In first quarter of this year, almost 61 basis points at a time when purchase volume was pretty light, just for seasonal reasons. We will be coming out with our second quarter number next Thursday, and it is going to be a very large increase from this. And in fact, it may be a record. You can probably expect it to be more than twice this 61 basis points we saw in first quarter. And again, very much connected to what we're seeing in capital market spreads. So last topic I wanted to talk about is to switch over to the servicing side. And the way I've phrased it here, how much will foreclosures increase, certainly betrays a sort of an expectation that I have. That I think that they're going to go up, and really it's a question of how much. But I do think there is a fair amount of uncertainty with respect to how much they're going to increase. And why do I think they're going to go up with at least to some extent, with some level of certainty. Well, if you look at the level of foreclosures nationally, and here, this is data from our National Delinquency Survey. The red is foreclosure starts, the blue is foreclosure inventory. This is data through the second quarter of 2020. As of the first quarter of this year, we were at a 35-year low for these measures. In the second quarter, you see that foreclosure starts number drop almost to zero, just because the moratoria were in place. I think the small number of starts that happened were on vacant properties most likely. But again, we're starting from remarkably low levels, so given the increases in delinquencies that we've seen, it would be extraordinarily surprising not to see any increase from here. But as these moratoria keep getting extended, when they happen, I think is still a bit of an open question. But I mentioned the increases in delinquencies, yet you see that here. This spike is showing up in the second quarter of this year. This is looking at total past due for different loan types. And I think certainly the one that jumps out to you is FHA at almost 16%. So well above the level of delinquencies that we saw in the great financial crisis. So tremendous number of borrowers behind. And again, just to clarify definitions, in our National Delinquency Survey, this is a measure of whether the mortgage payment was made according to the original terms of the loan. So if the borrower is in forbearance and they didn't make their payment, that number is delinquent. Roger, see your question? So exactly get into that. So yes, a lot of these loans are being reported as delinquent in this survey, but are in forbearance. There are also homeowners who are in forbearance who have been making their payments. In our data, and I'll talk to our forbearance survey in a minute here, about a quarter of the borrowers in forbearance have made their most recent payment. In our survey here, they would be reported as current, even though they're in forbearance. So this is very much focusing on the cash flow. Are the payments being made according to the original terms of the loan? Now, I think to Roger's question, for the natural question is, well, for these folks in forbearance, what's going to happen next? I think that's a really important question, is at the end of the forbearance period, are they going to return to being current? And are we going to see a lot of V-shaped changes in these delinquency rates? Or are these going to proceed to more serious stages of delinquency and potentially the foreclosure, short sale, deed in lieu, other types of resolutions that we spent so much time talking about last crisis? This is just another look at it, focusing in just on FHA loans. And what's interesting to me, this is looking at vintage data. So for loans originated 2014 through 2020, tracking their payment performance through their life. And obviously no mystery as to when the crisis hit in Q2 of this year, regardless of how long these loans have been outstanding, at least in the FHA world, each vintage showing a very similar, very sharp increase in delinquency in Q2 of this year. Now, the only positive we're seeing in this Q2 data is that the 30-day delinquency rate, borrowers who have missed just one payment, actually declined from Q1 to Q2. So borrowers that were hit with the shock in March of this year fell behind then. If they were called back to work in May and have caught up again, I think that would explain why that 30-day delinquency has come down. But what really has changed in this seriously delinquent measure is that more of those borrowers who had been 30 moved into 60, moved into 90. Even if we're getting fewer new delinquent borrowers into the mix, those borrowers that are falling multiple months behind have not caught up. Again, big question about what's going to happen at the end of the forbearance period. Now, here's one where looking just at data for Minnesota, regularly running well below the national rate in terms of 30-day delinquencies, and that's been true thus far in 2020 as well. The most rapid pickup in serious delinquent that we're seeing across the country is in states like New York and New Jersey, Nevada, Florida, some of the states that have been hardest hit through the course of this pandemic. Again, sort of local cover here. So even though that 30-day delinquency is certainly low, also seeing the spike in 90+ delinquencies in Minnesota, as we're seeing nationally in the second quarter, which is not quite to the same extent, but certainly having an impact. Again, nationally, it's so sectorally concentrated in terms of borrowers that are falling behind in arts and entertainment, in travel, in some of these sectors that just can't continue as normal in this during this public health crisis. So I mentioned our forbearance survey, which we do on a weekly basis. We have more than 50 servicers contributing data, about 37 million loans. So we think we're covering about 75% of the market. And if you look, beginning of March, pre-crisis, about 25 basis points of the entire market was in forbearance, so likely relating to natural disasters at the end of last year. Then the CARES Act passed, which provided up to 12 months of forbearance for all government-backed loans, so Fannie, Freddie, Ginnie. We started this survey, and you can see, maybe initially to track that yellow line, the incredibly rapid take up in the forbearance opportunity, peaked at about 8.5%, more than 4.5 million households. Since that time, in mid-June, we've now seen 9 straight weeks of decline in terms of the share of loans in forbearance, where we're down to about 7.2%. If you look at the orange line, so the Fannie and Freddie servicing portfolio, it peaked well below that, and has for 10 straight weeks declined consistently and is now below 5%. So we are certainly seeing loans in the Fannie and Freddie portfolio perform better in terms of a much lower share in forbearance and a much faster improvement than the rest of the market. The blue, the other end, the Ginnie Mae servicing book, made up of FHA, VA, USDA loans, peaked at almost 12%, now is below 10%. Maybe take a second to explain some of the squiggles there once we get into July. First, the gray line, the other category of PLS and portfolio loans, predominantly portfolio loans, that actually has been running at a higher share of forbearance than the total. So, peaked at about 10%, so much higher than the Fannie and Freddie share. And again, these are loans that don't fall under the CARES Act. So there's not the same legal requirement to extend forbearance, but lenders, servicers across the board have been providing it to an even higher extent than those covered by the CARES Act. But then once you get to early July, what's happened is a number of bank servicers have bought out delinquent FHA and VA loans from Ginnie Mae pools and put them on their balance sheet. So they have now become portfolio loans as opposed to Ginnie Mae loans for the terms of our survey. So you see the gray lines and the blue lines cross. And for bank servicers, now about 10% of their portfolio loans are FHA and VA loans for bank servicers as a whole. So just to explain some of those wiggles we're seeing. So to the big question from this section, what's going to happen to the level of foreclosures? I said they're going to go up because we're starting from such a low point as we came into this crisis. Certainly anticipate for the Fannie Mae and Freddie Mac loans that a large number of these are going to flow through into the deferral option. We've seen many of these borrowers exit remaining current. many of whom have paid off the forborne amount. Now, there was lots of concerns around lump sum payments a few months ago, but we are actually seeing many borrowers exit through the payment of a lump sum. You're also seeing many borrowers look to potentially refinance or sell their home, then paying off that debt, getting out of the forbearance state as well. But I think particularly in the Ginnie Mae space, and really noting those sharp increases in seriously delinquent we saw for FHA, I think that's where I have a bigger concern about borrowers exiting forbearance and sort of getting back on 2 feet again, making their regular payment, and do worry about more of a need for servicers in those cases to provide modifications, to provide various other sort of loss mitigation options, and certainly expect that in some cases, if borrowers are not able to return to work, there's going to have to be a home sale of one kind or another. So definitely a challenging time. I think that really is going to be the 2021 story on the servicing side, is as we get to the 12-month period for this large chunk of loans that entered forbearance in March and April of 2020, how is that resolution going to work? And very much dependent on availability of jobs and continued robust housing market to make it as small of an increase as possible. So let me stop there. Those were the themes I wanted to talk about. Again, expect a very modest increase in rates, but with that, expect that's going to be one of a number of factors that's going to eventually cause this refi wave to tail off. Certainly expect a very strong purchase market. What could get in the way of that? If credit remains too tight, or if builders and existing owners are not providing enough supply to the market. But I do see that working out pretty well. And if anything, expect home prices are going to continue to surprise to the upside for many people. And then again, on the servicing side, I think that is going to be our biggest challenge as we go into next year. So with that, happy to take in any additional questions. Had that one clarifying question, but.
All right. Well, if anybody has questions, please pop them into the chat or the questions box so we can kind of address any questions you have. Mike, we did get one question pop in about getting a copy of your presentation deck. I don't know if that's available for us to disperse to the folks that attended.
Absolutely. I will send it to you. You're welcome to send it out.
Awesome. Thank you. That would be fantastic. So please put any questions into the chat box for us. While we're waiting for a few questions to come in, I'm just going to plug a couple of upcoming events for the MMA. We have our annual golf outing, COVID related, from last, we had to delay it from July to August 25th. But we are going to have it. It's going to follow, the COVID social distance guidelines, and we do have a few spots open for some additional golfers. So I would encourage you to try to get into our website and get registered for our golf outing. It should be a fun event, a chance to connect with people. So we've all been doing these Zoom meetings for too long here. So, go out and enjoy a round of golf and with, proper social distancing precautions in place. Also in September 23rd, we are going to have a presentation about the new uniform residential loan application that is going to be going into effect first part of 2020. I believe it's March 1st. It becomes mandatory. So please sign up for that. It's September 23rd, and we will discuss the new URLA. So. Any questions out there? Krista, have you seen anything come in yet?
I'll take that as a sign. Maybe I explained things well.
Yeah, well, I really appreciate all the information. I especially enjoyed the fact that you pulled in the Minnesota data to go along with it. That was great to have a local a local spin on things to see how we stand with the national folks. Mike, one last thing. I just, obviously it's been on everybody's mind here with the new FHFA announcement with the 50 basis points G fee being implemented September 1st. A lot of backlash, a lot of discussion around it. In your circles, has that spurred any conversations where there might be some adjustments to that, or is that pretty much set and just everybody has to live with it?
Yeah, you can guarantee that is our absolute number one priority that we're working on right now. We know very well that both this is going to be an additional cost to borrowers, and I talked about impact of that, but for our members, the cost that they're going to have to eat based upon their locked pipeline. I mean, I'm hearing from so many folks every day, we're talking millions to 10 millions of dollars that they're going to lose if this goes through as planned. So we keep pushing on FHFA and the GSEs for a change. Absolutely want to thank folks that did reach out to their congressional representatives through our Mortgage Action Alliance. I think the latest number, we had more than 80,000 letters go into Congress. But we've never had an industry reaction like this before, and it's having the intended effect. Right. All across Congress, Republicans, Democrats, House, Senate, they're writing to the FHA with a lot of question marks. So, why are you doing this? You got to explain yourself. So there's a lot of political pressure being brought to bear. I can't promise anything at this point, but just know that it is our top priority right now.
Thank you. Thank you. I did see one question pop in. It says, did you say that you anticipate home prices to rise 3 to 4% in 2021?
That's correct. And then that's our forecast of the national FHFA home price index. And at least to the picture, Minnesota sure seems to be highly correlated with that. So we're riding right along in that kind of a level as well.
Okay. Well, I don't see any other questions popping in. We're 2 minutes to the top of the hour. Again, thank you so much for joining us today. Great information. And again, one final plug for a couple of things. Our upcoming events, the Gulf of Outing, our URLA presentation next month. And to Mike's point, if you haven't joined the Mortgage Action Alliance, please do so. If you have questions on how to do that, get a hold of our office. We'll get you the link. We'll get you the information so you can contact your elected representatives and stay up to date on the political and events that we need to stay on top of. Thank you, everyone. Have a great day.